Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, hey folks, so welcome back to We Build Great Apartment Communities. I am your host, John Brackett. I have here another great guest, Mike Zlotnik, who is an investor, not only a real estate investor, but a debt investor as well. So I think a great opportunity here, especially in this market, to have someone who sees both spectrums, right? Someone who understands how to underwrite to debt, someone who understands how to underwrite to equity. So Mike, welcome to the show.
Hey, John, thank you for having me.
You're very welcome. So I'm going to introduce you to our audience and share with them your background so they have a good feel for who you are. So Mike, I find it pretty interesting that you have a 15-year track record in the IT space, doing business intelligence, complex system software and processes, which is really, I'm sure, a great complement to the business that you're in now. So you also built your career in IT. You know, you have a passion in real estate, which is where you are right now. So I'm going to share with them what you're doing, okay? Because you've created some funds. And I know you're very systems and process oriented based on your background in IT. So in 2009, you joined Tempo Funding, which is an LLC. And it's a mortgage pool fund as a managing partner, right? And vice president of funding operations. So starting from January 2014, Mike has assumed the responsibility as CEO and has since founded TF Management Group, LLC, launching 3 new real estate funds. One is called TF Investment Fund 2 LLC, which is an income fund. You have Tempo Opportunity Fund, which is a growth and income fund. And then you have Tempo Growth Fund, which is predominantly a growth fund, right? So under Mike's leadership, the company has been transforming and growing, delivering strong returns for its fund investors. So Mike, welcome to the show. Lots to unpack here. Very excited to have you on the show.
Sure. Thanks for that introduction.
You're very welcome. So, okay, a lot to unpack here, right? It's a great time to have someone that underwrites not only debt, but equity as well. So in this market, let's talk a little bit about debt. Right? Because COVID is changing the landscape, changing how structures are being put together. I think one of the advantages of talking to lenders, I always say that the debt guys usually have a pretty good pulse on the market over the equity folks, because debt is preferred to equity, right? So typically you're being a little bit more informed. So what kind of structures are you seeing right now take shape in this changing COVID environment between debt and equity? If you had to comment on the type of capital structures that you're seeing right now between debt and equity, what comes to mind?
So I'm going to kind of jump quickly into the crux of the changes related to the COVID. So number one, during the COVID, we've seen credit tightening quite a bit. So the banks financing commercial projects, including multifamily, giving lower LTVs. So what used to be, say, 80% gone down to 75 has gone down to 70. Now, it doesn't necessarily affect agency debt. I think agency debt, Fannie Freddie, is still fairly aggressive, but bank-held paper is generally tightened. So the number one basic change is we see more equity requirements. So if you want to participate in the project, if you're a sponsor, you have an opportunity, you generally need to raise more capital, more equity capital than debt versus than before, as lenders have tightened up. So what has evolved as a result of this is not new phenomenon, but more of a result of COVID is preferred equity. So sponsors that can't get all the common equity raised fast enough, leverage preferred equity to help them close. So we've just done a deal. We've invested in the common equity of about 1,000-door multifamily project in Midwest that did have a preferred equity as a bridge between the common equity and the bank or insurance company who offer financing. So that's sort of one of the things I've observed that has transformed or transpired after the COVID. It doesn't necessarily, it's not new methodology. It's more of, you could tackle that on any project, but it's just an interesting change that because of the equity requirements have grown, the sponsors are gravitating to taking on some more preferred equity to reduce the common equity requirement and to increase the leverage that way. Does it make sense?
It does. So Let me ask you a couple of questions around that, okay? So, our audience, we have a combination of predominantly operators and limited partners. Or another way to say it is we have folks that have been actively involved on a passive basis as investors in projects, right? So, we kind of have a unique audience. So, with that being said, let's kind of unpack what you just said from this viewpoint of an operator, okay? So, you talk about sponsors that are good sponsors, that are strong sponsors. In this market, it sounds like they have a little bit more leverage, right, to negotiating preferred positions in opportunities, right?
So let me just comment on this. As a sponsor, as an operator, you're trying to take a project down, you need to get the capital raised quickly. So I'll give you an example of that project, just a very, very high level. The acquisition price was 97 million with change. And the common equity required, or the equity required to be able to get loan, which was 70% of that. So the 30% equity was two-thirds of it came in the form of preferred equity. The total equity required was 37 million with some change. 22 of it came as a preferred equity, and then the rest, 15 million with change, came as a common. So why it was easy, or at least plausible, is because preferred equity was a one investor. It's a very sophisticated institutional investor who wrote a big check for 22 million bucks.
Right.
But the common equity requirements was cut down from 37 down to 15. It's a much easier exercise to raise capital for that.
Of course.
So that's the benefit to the operator. To the common equity, the benefit is greater leverage. So on a common equity, preferred equity, if the project performs, obviously there's a higher risk because of that preferred equity senior. But if the project performs, the return can be magnified to common equity as a result of higher leverage.
Okay. But, the position that's in many cases preferred to equities is debt, right? So the debt position gets paid off first. So with that being said, how are you seeing debt being structured right now or priced inside of markets like this, especially on the bridge debt side, right? Because, here's one thing that we did once March hit and we got into this pandemic and it was official, right? We had the stay-at-home order. Is the very first thing I did is literally activated all of our bridge contacts. Okay. I was on the phones almost 8 hours a day, reaching out and activating all of our bridge contacts, right? Our bridge lenders, because that's what's going to start showing up, or that's what I felt was going to start showing up. And that's what I'm seeing right now, right? So with that being said, from an operator's viewpoint, where do you see the opportunity with bridge debt?
So there are the classic bridge lenders that are sort of institutional banks, and then there are hard money lenders. We don't finance debt at low rates of return. If we do only hard money. So it's expensive, and that's a bridge debt, but it's an expensive bridge debt. So the pricing on that bridge debt is still 3 to 4 points, 12% rate. That's a hard money bridge debt. In fact, tightened up. So the more competitive pricing where you could have gotten maybe 9 to 10, jumped back up to 11, 12 on the rate, and the points have increased because of limited supply of Wall Street-backed bridge lenders. So now we go into some of these Lima One, Lending One, Corvest. Their faucet was turned off completely.
Right.
So the Wall Street froze up. So you might have gotten a little bit more competitive bridge debt, but it wasn't backed by Wall Street. So there are portfolio lenders, and they realize supply demand is out of balance. So they've pushed their rates up. Before they could have been lending, as I said, 9%. Now they're doing 11, 12 because they can't. When you took out the other guys, as they come back, as the Wall Street reopens, you'll see some better bridge debt. But I think the rates are going to be higher than before, even though Fed dropped rates because of the risk. The risk profile has gotten a whole lot higher. So on the bridge debt side, again, Wall Street-backed lenders have been turned off. You got the banks. The banks are nervous through the nose. They've taken massive balance sheet loss reserves. They're allowed to do that.
That's right.
For the reason that they don't know, a lot of commercial debt is going to have problems. So delinquencies are up significantly. And it's your retail, it's your hospitality, some office is having problems. So the banks are in the mode of loss mitigation rather than let's do some new loans. So Fannie Freddie is flowing because it's backed by the agency agency debt. So the short answer to the question, the demand for hard money loans has increased because the alternative have dried up. That's been the observation. Over time, it may be reopening. Now, hopefully, things will reopen. For us, we investing in the equity of the projects. The one sector that seems to be lending still, based on relationship, insurance companies. So it's more expensive, but a little bit more flexible debt. So the deal that I just mentioned, that big deal, it was financed by one of the insurance companies, 70% of the acquisition price plus 70% of the construction budget.
Sure.
It's connections. If you have the access to these big players, you can get fairly decent competitive rates because their cost of money dropped even further with Fed cutting rates.
Okay. So I appreciate you sharing that. So I'm going to pivot a little bit, Mike, and you talked about trends a little bit. Okay. Some of the trends that you're seeing in COVID. You talked a little bit about, capital structure, your assessment on capital structure right now between debt and equity, and some of the things that you're seeing between preferred and common equity and how that's changing because of our changing market. So now I'm going to get into some of the qualities that you see inside of very strong borrowers, right? So when you're dealing with a borrower, okay, and so this is more of a question that's going to pertain to our operators. Okay, so when you're working or with a borrower, what has some of your experiences taught you about really good borrowers, right? Maybe what are some of the top 3 qualities that you've observed with great borrowers? And the reason why I ask the question is because that question will help operators out there understand what mind frame lenders are going to be in to be willing to cut checks, right? Or to lend money out.
Well, today there's even more focus on the balance sheet. So having more reserves. It's a financial quality if you can demonstrate better reserves, if you have better personal balance sheet, even though these are non-recourse loans, but they want to see greater reserves. That's the basic observation. From a quality perspective, obviously integrity. It always starts with integrity. People do what they say. So we watch it all the time. First signs of BS, when people don't do what they say, that's a red flag. So for us, or anybody we work with, and we are sort of religiously disciplined, we push people away all the time if we see changes in behavior or signs of bad behavior. Integrity is in the blood. So if you do what you say and you tell how it is, it's very important to us. Now, we're not diving into underwriting of files. I'm just talking about personal characteristics.
Sure.
So one is, again, do what you say. 2 is communicate. Just generally, do you communicate well? Very, very important. If something's happening, you let us know. COVID has taught us one thing. It's good to over-communicate. At least for a period of time, we were communicating a lot to our own investors, and we manage funds, and investors were anxious for a while. Now, it's sort of calmed down now. People are a little bit more relaxed, calm. It feels like things are improving. But communications have always been critically important, right? And then the final personal component is ability to solve problems. So we want to see when there's a problem.
What a great comment.
Yeah. I want to see how you're solving problems. So when people, first of all, you can bring a problem to us. My hope is you will solve your own problem, you'll deal with it. But if you bring a problem, if you can't solve a problem, at least you can show what you've tried. So depending on the situation, the problems don't necessarily need to be bad, but they can exist. I mean, if you have let's take a retail deal. So retail deal, they've been suffering. They've been shut down and cash flow has been cut and they've entered forbearance. But going through the process and exploring all your options and coming to your investors and saying, listen, we have the following challenge. We've been shut down. The tenants have asked for rent, a holiday for a couple of months, and we've granted to them because we want to keep them. But we still have to deal with the bank. We still have to deal with the loans. We've been able to obtain the following forbearance. And we've also been able to increase the reserves or this and that. At the end of the day, if you can demonstrate what you've done, this is a whole lot better than say, I'm out of cash, I need more equity injection, help, right? It's at least going through some level of problem solving. So those 3 things are kind of critical characteristics for anybody at every level.
Okay, I think that's tremendous feedback in this marketplace, right? Tremendous feedback. So liquidity, okay, your ability to be able to demonstrate that you're a person who does what they say, okay? And one of our favorite sayings in our office is don't trust what I say, trust what I do. So I'm a huge proponent of what you just described. And then lastly, the ability to solve problems, right? I always say that your income is going to rise to the direct proportion by which you're able to solve problems, right? If you're a strong problem solver, guess what? Your income is going to rise in direct proportion to that. So I really like that. So Mike, I'm going to unpack the liquidity portion a little bit, okay? So in terms of liquidity, can you quantify that? Is it typically 10% of net worth? I know that with the agencies, it's a little bit different, right? They're requiring a reserve that's usually proportionate to 1 year's worth of debt payments, right, or debt service. But from a balance sheet perspective, right, as a lender looking at someone's personal financial statement, okay, what is the ratio that you typically like to see in this market in terms of liquidity? Is it 10%, of net worth, or are there other components that you look for?
So let me make it very clear. I'm not a classic commercial hard money lender. That's not what we do. We do fund hard money. We finance smaller fix and flips. We do occasional bridge loans on development projects with people who we know many years of experience. So, but what I've seen on the projects we finance, we've participated in the equity of a lot of deals, preferred equity and common equity. We do see general requirement has gone up. So 6 months reserve is absolute minimum now of ability to service the debt for 6 months, ideally 12 now with agency, as you mentioned. From a balance sheet perspective, it would be good to have liquidity to solve problems of at least 1 year worth of debt services. It doesn't have to be specific reserves for this project, but a year worth of reserves is sort of a bare bones. We've not looked at a 10% of net worth. It's not as relevant of a ratio as a project-specific reserves. If it's a non-recourse loan, the personal balance sheet doesn't make any difference.
Sure.
If it's a recourse loan, it's a different story. Most sponsors that we see still get non-recourse paper. They don't want to personally guarantee a large loan. This project I mentioned is, again, it's 97 million in plus 20 million construction, all in about 123 million. I think the first debt is 86 million. The 20 hold back, the rest is financed with closing. The sponsor just doesn't want to guarantee that size of a debt personally, right? It's just they don't. So personal balance sheet is less relevant. What is relevant is on that project, there is a significant interest reserves to service. That's the primary mitigation mechanism. Also, we're gravitating today, just one comment, to more light value add projects, not heavy lifting. So that project is cash flowing from day one. We finance projects with heavy lifting, 50% occupancy. Those are much harder to finance today. It's a much easier play is to get Class A area, Class B aged property with good cash flow day one and then gradually increase it. That's what I feel, given the uncertainty, is a better play today versus heavy lifting. Although we've done heavy lifting multifamily too, just a couple of years ago. Now I would think twice before getting into some heavy lifting.
Okay, so I'm going to ask you, you said something that I believe I heard you say, which is, in this market, you're also looking to explore taking preferred equity positions, right? Did I hear that correctly?
Yes.
Okay, which makes a lot of sense, right? It's another way to mitigate your risk. I get it. Makes a lot of sense, right? Frankly, probably can be, I don't want to say easier to price risk when you're taking that position, but you can quantify it, I think, in some cases a little bit clearer, right? Especially to your investors. So a couple things to that, and maybe if we can just kind of unpack that for our audience, right? So when you're taking a preferred equity position, okay, I've seen this done a couple different ways. And so this is really more of a question for you. Are you 100% in that equity position, or is it a debt equity combination where you're taking a preferred position in the equity and then you're reducing your cost of debt and taking a first deed of trust? Or is it just 100% equity with a preferred position and then you have debt below you?
So again, wearing a hat of an investor who tries to maximize risk-adjusted return.
Sure.
There's no interest in the first lien cheap debt. I mean, the yield on that is just too low for us. I believe it's grab what you can from the agencies or insurance companies. That is great cheap debt. We are participating in the preferred equity or common equity. So I do want to see first lien debt, great terms, great. If it's interest only for a couple of years, or if it's got a 5-year, and all that stuff is very important from the point of view that feels safe, that the first lien debt is conservative, not over leveraged, low interest rate, and ability to service the debt. Then when we look at the preferred equity versus common equity, what coupon can we get and what piece of the common equity? So we've done preferred equity. I'll give you some examples.
Sure.
So in the deal that I explained, the preferred equity on that large deal was underwritten to 12.5 preferred return with payments somewhat lower, given the cash flow doesn't support that kind of distributions. It starts with 7, 8, 9, all that, increases with years after the value add. But it's written for 12.5%. And then they took 20% common equity, putting up roughly 60% of the total equity required. 60% preferred, 12.5% rate, 20% common equity bonus for participation. So from that perspective, that's what it can look like. We're entertaining a bridge preferred equity now, when actually a self-storage project, not multifamily. But the structure, we're looking to ask for 18% rate, not 12, but 18% is a bridge, and take a smaller piece of the common equity, right? So the reason it works is they're trying to raise a certain amount of common equity, and they need to close fast. And the operator, in this case, has a great educational platform. They have a lot of what I call them mom and pop investors. Mm-hmm. Absolutely giving them all due respect. But they invest in common equity on, non-institutional terms. That's okay. But it takes time to gather all these people. You have to market to them, and depending on your network, sometimes you run out of them. You've got too many projects.
Right.
So the time it takes to get all the capital to close is not, too short. So that's where we come in. We'll give you a bridge. We'll charge, as I said, 18% plus probably get, 10% of the common equity. By the way, that depends on how much equity is behind us and how long we're out. So we'll vary how much common equity we'll take depending on...
Meaning how much common equity is on top of you.
Yeah, top of us, behind us. They're junior to us on a capital stack. So if we're putting up 1/3 of total equity required, we'll take less. If we're putting up half, we'll take more. So,
sure.
But that's the methodology. From a common equity side, obviously you don't want to see preferred equity ahead of you, but if they can't close, they can't close. So the game is opportunistic right now. It's bridge. It's a bridge. Instead of bridge investing, instead of bridge lending in first, they can't take 18% loan, but they can take a little bit at 18%. Does it make sense?
It does. So let me clarify that from an operator standpoint, right? And expand on the benefit that you just described, okay? Because so one of the things that we do inside of our underwriting is we really get clear on what our cost of capital is, right? Combination of debt and equity. So if you're stacking your capital, whether it be debt, preferred, common, at the end of the day, as an operator, you should be able to determine what that cost of capital is, right? Just like a bank. A bank is really clear on what their cost of capital is. You do the same thing. But one of the things that you brought up, which I thought, actually, you're right. It's a great benefit. As an operator, if I can understand really clearly what my cost of capital is with the blended structures that I put together, then I should be willing to say, okay, well, there's a price for faster capital, right? In this case, equity. There's a price that I'm willing to pay to be able to bring in money quicker, especially if it's a large dollar amount. So if my equity cost, for example, say on a blended basis between preferred and common, say it's 40%, okay, or whatever that is. But I know if I can bring in, of that 40%, say half of that is preferred and the other half common, as long as I can meet that structure, say the deal still cash flows and it makes sense and I can make distributions and hit everybody's targets, then what you're saying is at that point, that could be a viable option to be able to fund your deal. And that's what you're doing in this case, right? The money.
Let me just give you some commentary on this. So generally, that deal is, we're still working on this. The common equity, they're trying to price the return to investors target between 16 and 18%.
Sure.
So this is between the pref and a waterfall. But the target return...
So when you say price, though, you're talking about an internal rate of return, right?
Yes, IRR.
Okay.
Obviously, when I want to self-storage ground-up construction, most of the return comes in the back end. But blended average is 16 to 18%. And they would love to stick with it. The problem is it's a time to close. We're offering them 18% money, plus they will have to shell some equity. Can they afford it? I don't know, but it's a bridge to doing a deal or not doing a deal.
Sure.
So you, as an operator, if you can raise all the money at the lowest cost of capital, so much more power to you. If you can't, you got to go through the exercise and figure out where else can I get the capital? And yes, it's more expensive capital.
Okay, so let's convert that into a benefit for the operator, right? So that people can better understand what you're describing and why they should pursue a structure like this, okay? So you just said, okay, the common equity cost, well, total equity cost was roughly around 16%. And that's what this particular operator would choose. Ideally, that's what they are able to create, right? If everything goes perfectly, that's their ideal situation. They'd love to fund the equity at that cost. But it doesn't sound like that's going to happen, right? So if they bring your money in, okay, now that cost then would likely magnify to what, 25%?
Well, it's going to jump over 20. So the common equity they're going to give away is going to have a value. So we'll get 18, maybe we'll be in somewhere low 20s. But at the project level IRR, the project level before the cost of money is 25, 26, 28%. You could still afford low 20s, and you will dilute a little bit return to your common equity investors. But without it, it's a question of can you close or not.
Okay, good.
The answer is not necessarily optimization, but if you are very confident in your ability to raise capital from common, you don't need preferred.
Right.
It's a better deal. The other way to look at this is the deal I just described, that preferred equity, the bigger deal I just talked about, $97 million acquisition. The cost of preferred equity is about 12.5 plus the common equity component. Maybe the total cost of that equity is only about 18 in the high teens, while the project level IRR on that project is in the very high 20s. So you can actually afford to take a preferred equity piece, knowing that you have enough upside behind it to create a spread. So it creates a little bit of arbitrage.
Okay, beautiful. And I get it. I totally get it, right? So let me kind of close out the loop on this conversation. Okay, so, and this is where I was going with this, right? If ultimately your cost of capital on a common basis is 16%, okay, but you know you need quicker money, that quicker money is going to come and it's large money, right? A lot of dollars, it's going to come with a higher cost, right? What you're proposing is, hey, look, you can go and pursue more sophisticated dollars, going to be a little bit more expensive. However, right, if you can close with those dollars, even though it may absorb most of the cash flow that you're underwriting to in the short term, right, you can use that as a bridge and then raise the remainder of that, okay, and then replace your equity with less expensive equity. I've done that before. Now, here's why I'm bringing that up, right? The only reason why I'm bringing this up, Mike, is I understand your position, right? As someone looking to inject capital into deals. Of course, you're not doing it for free. From the viewpoint of an operator, it's about capital sources, okay, and understanding what that money is going to cost to make the deal work, right? Because here's the reality. If that money is too expensive, okay, irrespective of you being willing to do the deal, no one is going to buy into a deal that doesn't make money.
That's right.
Otherwise, why do it, right? No one wants to work for free. But there is a way to be able to use quicker, a little bit more expensive, more sophisticated money as a bridge until you can finish your raise and replace that equity. I have done that, which is why I'm a huge proponent of equity lines, okay? And that's why I'm a big proponent of making sure that you have properties with adequate equity in that lenders are completely okay with taking a second position on for that exact reason, right? So that I'm not rushing into a deal, even though it's a great deal, it's a super deal, okay? You know, I don't do the deal because I can't close fast enough. The capital is too expensive. So I love equity lines for that reason. It gives me a quick opportunity to close, right? First position, cheap debt. Second position, my own equity. And then I replace that equity, you know, usually in 60 days or so. So I like it. Makes a lot of sense. I really appreciate the commentary. Okay, so I'm going to move forward. Okay, I'm going to fast forward a little bit. I think that was a great discussion for our audience. One that covered not only debt, but the equity, different structures, including preferred equity and common equity. Okay, so now one of the things that I'm hoping you can share with us, Mike, because you see a lot of different transactions, right, from different viewpoints. So when you're in this market, where are you seeing the most profitable multifamily investments? What market areas? Where are you seeing some great opportunities right now?
So the basics of most of the cash flow focused it's Midwest, Southeast. So it seems to be kind of a common thing. There's a lot of interest in these markets to generate some level of cash flow and have the value add through improvements, renovations. And they're much more steady Eddie markets. So the coastal markets, I mean, I'm in New York, and it's been a great appreciating city. The primary problem here is that now it feels very weird. I don't know what's going to happen. It's hard to say. I don't know. I mean, you're in San Diego. I'm middle of the road politically. I'm not trying to take any sides.
I get it.
The challenge is I don't know what's going to happen. It's a high uncertainty. So where do I prefer to invest? We obviously invest first with people. We always start with people. It doesn't matter where you're at. If you're a company and operator, we invest here in New York. We actually invest in distressed commercial debt. The LTV or ITV, investment to value ratio, is low enough, we'll buy that first lien mortgage. We do that. We actually have a very, very competent operator here. And it's very, very defensive in nature. You can buy paper at 50% ITV, works really well. But as an equity play here in New York, it doesn't work. The cap rates are so low, it just doesn't work. You can't touch anything here from a pricing perspective.
That's a great point.
So we want investments with some cash flow and a value add. That's why, I mean, that other deal is in Indianapolis, right? We like those markets. We have a number of investments in Midwest and Southeast, and we continue to work with the guys who we know, like, and trust. I mean, these are the key words. There's no start until that happens. Know, like, and trust. Once there's no like and trust in a project in Pensacola, Florida, we'll take it. If they got another project, another second, not major MSA, but secondary MSA, smaller cities, we're happy to look at them. And the short answer, these are the safer opportunity zones right now, Midwest, Southeast. Obviously, avoiding some of the Midwest could be Chicago. Right now, I'm not crazy about Chicago. We already have a project in Chicago, and they're delaying construction or with regulation and all that stuff.
You think California is tough.
Right. So that's the point. I want to stay away from the heavily regulated, difficult to do business in cities. I mean this with all due respect. That's the challenge. It's just you just don't know where you're going to be. California today, I just heard they're raising taxes through the nose, or there's a proposal. And when I heard that, it's a little crazy, but they're going to drive business away.
Yeah. Well, I mean, that's nothing new. I mean, to your point of not making this a politically charged conversation, right? But that's the challenge, right? When you deploy a couple $1 trillion into the marketplace, that money has to get raised somehow. And the only way for the government to do that, right, is through tax dollars. I mean, they're not a for-profit entity. Let me say this, though, even though they're starting to partner with a lot of private equity funds, right, on repositioning a lot of these problems. And I think that's a smart move. But there are also a lot of strings attached to that money. And that's a topic of another conversation. So I agree.
Let me do one quick comment on this. Sure. So repositioning, this is what we like today. I'm going to give you one sector I absolutely love. And I think it's a phenomenal opportunity for people. So this is my give to your audience.
We like that.
So there is a number one opportunity I see. So what's happening right now with hotels? They're empty. A lot of distressed hotels. Conversion to affordable housing. That's the land of opportunity right now. We have one investment today. We're going to make a few more in the near future. We have a couple of potential projects. I feel that it's politically very, very welcomed in many cities. Sure. Affordable housing is the magic words, right?
Right.
There's not enough of it. You're going to please politicians on both sides of the aisle, right?
That's a great point.
Dysfunctional hotels. We did a project in Mesa, Arizona, downtown Mesa. Old Ramada is being converted to affordable housing. So this, I believe, is a land of opportunity. If you're a multifamily operator, if you can find a good project, it's a whole lot easier to convert to construct from ground up. So if you're thinking do a ground up, well, think at the same time, can you do a conversion? Right. You can do a conversion at a much lower cost, well below reconstruction cost, obviously, if you can buy it cheap enough, if it's dysfunctional, if it's been taken, it's being foreclosed on now, and when forbearance runs out, I think it's going to accelerate in Q4 and beyond. More and more assets are going to be in distress when the forbearance runs out. That's the land of opportunity. We're doing one. We're probably going to do two more fairly soon. And the numbers, the IRRs on these projects is pretty good. I mean, they're in the 20s. Yeah, I mean, you have no cash flow during the conversion phase, but the risk level is pretty, you're not building it. You're not over the budget. You can actually build a lot of reserves.
Sure.
And convert, and then you can lease it up fairly quickly. this is not a self-storage facility. It takes you 3 years to lease up. You have affordable housing, you put the word out, you fill up in 2 months, 3 months.
Interesting. Well, I appreciate you sharing that. And of course, that IRR only makes sense if you execute, right?
Yeah, if you execute, but then you have to go through cash flow projections. Cash is the king. So we look at them. If you can convert, it doesn't take as long to convert, and it doesn't take long to get them leased up. And if you're more or less right on rents, you can start cash flowing. Worst case scenario, you have a cash flowing asset, and that's defensive. So it's still speculative in nature. I mean, we like to there's a whole methodology about, I call them investment grade versus speculative grade. Any kind of development is speculative. There's risk. There's always risk in everything.
Of course.
But if you're trying to find easier lifting instead of ground ups, this might be an interesting opportunity.
So I'm going to just touch on one of the comments that you made just about repositions, right? So a couple of months ago, I think 2 months ago, I read an article in the paper. I think it was the Wall Street Journal, if I'm not mistaken, if someone wanted to search for the article. But I think there was $69 billion raised by private equity, the most ever raised in the history of the United States, targeted specifically for distressed assets, right? So I found that very, very interesting. And I think needless to say, there's, some pretty decent amount of money on the sidelines waiting to kind of see how this stuff shakes out. So to your point, though, you're anticipating, 6 months, maybe 12 months. And it sounds like you're being patient along with everyone else.
Yeah. Just one comment there. I remember reading that article, maybe the same article in Wall Street Journal at some point in April, that there were not, whatever you said, 68. I remember I read 400 billion, something significant.
Oh, it was larger than that. Yeah, no, it was a large amount of money.
Committed.
They're committed. They're soft commitments. They're soft commitments.
Yeah, but everybody expected the problems to hit a whole lot earlier, except for the government, wrote all the major checks. The Fed took action, and then the forbearance became the word as common as I don't know, sliced bread. So it's the forbearance. Residential, it's going to keep dragging out. I believe residential will get pushed, and residential foreclosures will not be allowed, or will be very, very slow because it's just politically suicidal in the election year. So that's probably going to get pushed. Commercial stuff is going to run out of forbearance, and there is no political will to save some of these hotel operators and so on. It's just not there. Right. So you're going to have commercial restructuring and foreclosures kicking in after the forbearance runs out, and most banks have given 3 to 6 months. So Q4 is the start of more opportunities, and then we shall see where we are with everything. There's a lot of unknown.
So with that said, Mike, and we're
I got to wrap up. I apologize. I'm running out of time.
Yeah. We're coming towards the end of the show. So, hey, thank you so much for participating. It's been a great conversation. Always excited to have you on. Look forward to having you on again. How do people get a hold of you?
So, Mike, you can see in my background, my podcast is called Big Mike Fund. So you can go bigmikefund.com.
I like it.
And if you misspell it, bigmikefund.com, I promise it's not a kinky site. Yeah. So it's
a sense of humor too.
Yeah, I appreciate that. Bigmikefund.com is the easiest way to find me. There's a way to schedule chat through Zoom, and that's the best way to reach me.
Okay, that sounds great. Hey, well, thanks again for being a part of the conversation. It's been a great conversation, a lot of insights shared, and I look forward to your continued success, Mike, and I'll reach out to you shortly. Thank you, John. I appreciate your gracious invitation, and same best wishes to you. And I would love to have you on the Big Mike Fund podcast. Sounds great. I'll reach out. Have my admin reach out. Thank you, Mike. Appreciate it. Thank you. Take care. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.